Hey, Chris, what's up? Good morning.
Hey, how are you, Brian? I'm good. How are you?
I'm good. This is Brian Jones. I'm here with professional trader and world's most interesting man, Chris Hood.
Man, this hair. I honestly, I've got to apologize, man. I'm so close to getting a haircut. It's nearly time for us to go out of our houses in Canada.
Yep.
I have my vaccine. I'm growing my third arm now, so I'm going to be even harder to tap when I get back on the mat. It's like,
That would
how
be
are you going
crazy.
to beat a guy with three arms? Like,
I don't know. I mean, that's like a dude with three legs. You're trying to take them down. They always have a third post somewhere. You're like impossible.
you obviously haven't wrestled in Africa, man. No, it's all good. I think that we're doing quite well up here. I've got a feeling that the light's at the end of the tunnel. I got my shot. I was pretty impressed. I just walked into a pharmacy and off they gave it to me, and I was pretty comfortable with it.
So you had your second dose now, right?
No, first.
First dose, okay.
Yeah. I'm not that old.
Have
It's only
you?
the 80s and overs that have gone for their second now. So thanks, Brian. Appreciate it, man.
Hey, I don't know the policies, man. You look
I
young,
roll like an 80-year-old.
but you're getting ready to be able to get back on the mats.
Oh yeah. I'm starting to move my hips a little more. It's just I feel like a board. I'm just completely stiff. It's crazy, but it takes time. At my age, it takes a long time to warm up.
Yeah, I like warm-ups. I used to hate them. I love them now.
I know. Since I got my purple belt, I'm allergic to warm up. We just walk in at the end.
Yeah.
So all good. The market looks reasonably interesting at the moment. The Bitcoin thing, and I see AMC is making a bid for more news. So it looks like a few hedge funds are going to be out of pocket again over the next couple of days.
So you're going hard and heavy into this AMC?
Nah, you know what the thing is? I think when you get into trading, you've got to find the pool that you can swim in. And I'm not a very good day trader. I find it very frustrating.
Mm-hmm.
You could land up having 9 losses in a day, and then one good trade at the end of the day and makes back all your losses. And then you look at it and you go, all that work for this is like, it doesn't make sense to me. And I think with this whole Reddit army and what have you, I think there are a lot of people who don't really know what they're doing, swimming in a pool that's got an undercurrent they can't see. And eventually they're going to get sucked down. The thing that people don't realize is hedge funds and the big whales don't lose. At the end of the day, when you balance it all off, they just don't lose. Eventually that money will go back from those guys and it'll go back in another way. So, rather stay out of those ponds. It's not safe for amateurs. And I don't play in that game. It's pointless.
I'm going to make a confession. I did put a few out of the money calls down on AMC like the last time it was going up, and I made some money. So and they were cheap. They were cheap. Whatever.
If you play it and you make money, fantastic. Like good for you. Like I look at it and I go, good for you. I'm never going to decry anyone who makes money. But if that's the primary strategy, then there's a problem because you can do that for craps and giggles on the side and get some fun out of it. That's cool. There's nothing like taking a win just because it's there. My broker platform here in Canada doesn't allow me to play in GameStop or AMC on the options side. It just doesn't let me do it. So they've almost protected me against myself, kind of thing, which I think is a little silly. At the end of the day, if you want to take a bet, you should be able to take a bet. I think here they're a little. The regulators here are like a little bit of a nanny state. It's crazy. So I think that there's going to be some money to be made. I wish they would put their attention more on silver. That's where my money's bet. But what can you do? It's just the nature of the beast. It's changing. I think the whole market is changing. Too many people lost their jobs. They see trading now as the, job alternative going forward. And unfortunately, easy money creates relaxed rules. And when you have relaxed rules, it's easy to take money from the impatient and give it to the patient sort of thing. It's like, this whole game is not a value-added game. And this is something that most people don't realize. In trading, no one's really creating value. All right. There is no value. The pie is only this big. And what happens is you've got some people who are just taking pie from other people. That's all they're doing. They just take. So I read the other day that something like, 4 million new accounts opened at Robinhood over the last couple of months or something crazy like that. And most people would go, oh, but that's just, there's too many people getting involved. And as a professional trader, you look at that and go, fantastic. 4 million more people from which we can take money. That's how it is. So you've got the experienced people on the one side encouraging you to come in, because if I can take that money out of your pocket and put it in mine, I'm doing a great job. Like that's my job. Whereas those guys are going, well, what edge do I have? They've probably got the Reddit army. How many people on Reddit post their losses as a badge of honor? Like, have you ever gone in there and
I've
read
not actually. I have a friend that posts things, in a chat group about it. I mean, not a trading chat group, just some friends, and
yeah,
he's all into he's on the AMC train, and I'm like, well, I hope you make a fortune.
So do I. I hope that I'm all for the big guys getting taken out. I think that they screw us every single day, whether we like it or not, in the aftermarket where we can't play. So, hey, if you're getting screwed during the rule sets that we can play in, I'm all for it. So I encourage them, go ahead and do it. Doesn't mean I'm going to put my money with them. Right. I think that you've got to treat the two very separately. I'm very supportive of the smaller guy winning. I'm not supportive of the smaller guy losing because they're stupid. Like that's, I think there's a balance. And the problem in the market is the market will reward bad behavior all the time. And if you're getting rewarded for something and you don't know enough, you don't know what you don't know, you're not going to know that you were rewarded for a mistake. So you're going to keep doing it until the one time you put 50% of your wealth in and you lose everything. And that's where the big guys will win. They're not going to win these small little battles. This AMC thing is a little battle. It's a little skirmish. Think of a civil war in some third world country. It's a fight for a village. It's not the country battle. The country battle happens at much later date. Little skirmish here. I don't think they're even going to bat an eyelid, to be honest. I think, for some of these guys, losing $1 billion is a day's job. It's not the end of the world.
Yeah, there's a lot of money out there. So we were talking about before, what do you, so we've covered crypto a little bit. I know that's still a big hot topic, but what about the marijuana stocks?
I quite like them. I mean, look, I think the product is fantastic. I think more people should use it. I think the world would be a much better place if everyone had, 3 daily servings of weed. I mean, look, that's coming from a guy in a country where it's completely legal. Okay, so, fantastic. If it's not legal in your country, this is not an encouragement to go and do it. I think that there's some life happening there. There's definitely some green shoots, pardon the pun, in the marijuana sector. So worth looking at. The problem is it's a very, very illiquid market. Mm-hmm. So it's not something where you can just go in and buy something. Please be careful. Don't just buy something where 2 shares trade hands every day. I mean, that's like, a recipe for a disaster. Stick with an ETF. Try and keep your volume up above 50,000. If the volume of the ETF is below 50,000, just avoid it. It's not really worth getting in at that point, but there is definitely some green shoots there. On the crypto side, I think there's a lot of damage. And if you read the press and the media and what they're doing, remember with crypto, particularly Bitcoin, if someone is promoting the virtues of Bitcoin, it's not really promoted from the perspective of benefit to you. All right. If you're not a holder of Bitcoin, it's not in your benefit that they're telling you it's a great idea. It's purely self-interest. So anyone who promotes Bitcoin or, whatever it is usually promoting themselves from their own perspective of a position that they hold, because it's a limited distribution product, right? There's only so many that are getting made. So if you're an owner of Bitcoin and you can encourage another 10 people to go in, that obviously pulls the price up. It's in your interest that those people go and buy. It's purely out of self-interest. And that, to me, takes away a lot of the attraction of the product. Because are you buying it because everyone else has got it, so you've got the sort of network effect pushing the price up? Or is it really fundamentally going to replace currency? And if you think of currencies, no currency can be used generically across the world if it loses its value like Bitcoin has over the last month. So I think that the idea of currency, when they use the word currency, I think we need to change that. Because it's not a currency. I don't see it replacing your US dollar bills, to pay for your groceries kind of stuff. It's not going to be there. So I think Bitcoin's got a lot of damage technically on the chart. I don't think it's finished yet. I think that they're going to sucker people in to buy at this level and then swash them out again. And, I think that we're going to be in a little bit of a cycle for a while. Where I think the opportunity lies at the moment is oil. I think oil and energy, definitely an opportunity. Nvidia, what a company, man. They did that 4-for-1 stock split and came out with some pretty good numbers, and now you see the stock. I think that stock's going to be back to very high triple digit numbers in no short order once that split happens. So Nvidia is doing really well. Google, another one. Google's apparently bidding to provide some cloud services to Boeing. And Microsoft is also involved in that. And if any one of these companies gets it, it's a huge, bottom line number. So Google, Nvidia, I still like gold. We did a great trade on gold over the last month and a half that made us some money. But yeah, I think at the moment there's a lot of opportunity. You've just got to be really, really careful about where you actually throw your money at, because not all opportunities are equal. And I wrote about this last week to my subscribers, and that is, you should spend more time trying to identify the pond in which you are trying to fish than fishing itself. It's a lot safer if you actually just do your work to say, you know what, if I break down my understanding of the world as it is, these are the 3 ponds that have got the most opportunities for me to catch fish. Whether I like those fish or not is absolutely irrelevant. As traders, you are here to make money. You're not here to, oh, I only like doing this, or oh, I only like doing that. That's not our job. So, trying to identify areas where rotation is occurring, but it's putting those stocks or elements of that sector into an upturn, and that's where you want to trade. So, we wrote about that this week around how to build that watch list. If you can have each week a short list of 10, maybe 20 different trades, those are the trades you're going to do on these shares. Those are the ones that you watch. You shouldn't be like a squirrel. Every time there's a new acorn, you run off and, you ditch the one that you've got and you go find this one. And this one turns out to be infested with a maggot. And then you go find another one. It's like building a really sensible watch list is the first step in creating a process that's completely sustainable. So, there's a lot of opportunity. I think it's very, very easy to get suckered into the next best thing. Your buddy at the gym telling you that the stock is going to be $500 in 3 weeks kind of stuff. And just don't play those games.
So what sort of things should people be looking at for let's say the summer, coming up for the summer?
I think energy, the inflation trade is definitely still there. Right. So energy, I think that there's going to be definitely stuff like, the things that you buy at the supermarket. So
by the inflation trades, you're talking about commodities and
well, commodities that translate into things we buy at the supermarket. So, wheat translating into bread, right? So, that we all know, regardless of what the government says about inflation, we all know that the cost of living has gone up. When the government goes out and says, oh, inflation is 1%, well, let's compare it on, that steak that you bought last week that cost you $20. Last year it cost you 18. That's a 10%. So how can inflation be up like that, right? So when you start
things are definitely more expensive now.
Absolutely.
And then I had someone tell me that we were making some commodities trades, and I was watching wood, and then I heard overhearing somebody else talk about it outside the stock market sort of context of just how expensive it was to build this deck that they were trying to build. They're like, I'm just going to wait.
The wood prices, the lumber prices were parabolic. I mean, soybeans went parabolic. We traded that one trade on soybeans and corn. Wood was just ridiculous. So we all know regardless of what the government says, we all know that the price and cost of living is going up, no matter where you live in the world, right? It's everywhere. So what you do is you break that down and you go, well, during the summer months, Stock Charts has that really interesting rotational graph that you can see, as well as the seasonality graph. What you have to look at is certain seasons of the year, certain stocks do better than others. So right now for summer, healthcare, energy, consumer staples, those would be the three areas that I would be going in for, right? So, healthcare, Johnson & Johnson, Pfizer, consumer staples, we'll have a look at some of the companies in there. There's some tech rebounds. So this is the thing where you got like little segments of technology that are going to do well, driven by things like NVIDIA and their announcement, right? So semiconductors might go up, gaming technology might go up as well. I don't think that the NASDAQ story, though, for summer is as particularly strong as, say, something like the Dow. I think that the Dow might land up being stronger over summer because of some of its components are all part of the healthcare, consumer staples, and energy type story, right? So you've got to start at the top and you've got to create the sort of theme. Once you've got your theme, you can identify the strings on that theme. And once you've got the strings, you can understand what's inside each of those. Because not every stock is going to operate as effectively as the others, right? So being able to fish from the top down, I think, is the key. It's honestly the most important skill as a trader. Because if you're doing the right trade on the wrong stock, you're still going to lose. You're going to have to identify the pond first. So I spend quite a lot of time building a watch list, maybe 10. Some stocks, sometimes it's only 10, sometimes it's 20, sometimes it can be 100. If it gets to 100, I start refining it even more and I start dripping it down. But building that list is the first step, especially over summer. You don't just want to be assuming things, and that's the danger of the sort of newspaper approach. If you're watching the TV and all of a sudden company A is on TV, it's like, oh, I'm going to buy them. And then, company B comes on, oh, no, I'm going to buy them too. And then I'm going to buy that guy. Eventually, you'll end up with 30 things that haven't worked. And usually, when you watch television, especially financial media, their job is not to entertain. It's to entertain you enough through anxiety to keep your eyeballs on the screen so they can sell ads. If the stuff happens to come through a TV journalist's mouth when it comes to why a stock is moving, I don't believe them. It's like they don't know any more about the market than you, and they're not telling you the reasons why things are moving. They're telling you the things that are going to keep you interested and anxious.
That's kind of how I feel about the news in general.
Yeah, that's their job. Honestly, it's like you have to wean yourself off the financial media because give me a second. I don't have a clue what that is. Sorry. This thing with this Apple stuff, all this Apple stuff, they do things sometimes, and I'm too old to learn new tricks. I'm still remembering how it worked at the beginning, and beeps happening all over the place. Yeah, you're right. Media is not designed to inform. They're not. They're designed to keep you anxious. That's their job, because good news doesn't sell. Like, how many times have you turned on the TV and they went, you know what? It's a great day today. I mean,
it's always got to be a crisis or a tragedy, or this person.
That's how you keep people.
This group hates this group, and whatever. It's like it's very polarizing.
And this is the thing, particularly in the financial media, that they're going to talk about, oh, the market's up 5%, but watch out, there's a bubble, or the market's down 10%. Woe betide your retirement account. I mean, it's like, there's never any, just play, be sensible. Every single person in the media, I don't think there's one financial commentator that I will put any credit on. None. I don't follow them. I look at charts, and the charts will tell me sometimes things that are completely different from the clowns on TV. And, I trade to the charts. I don't trade to the clown on TV. It's very, very disappointing, especially when you hear people, when I take on new clients and I say to them, so how did you find out about that stock? Oh, I saw it on CNBC. Okay, how did that work out for you? I have one client that actually shorts everything that Kramer suggests. It's like if he says go long, the other guy, he goes the other way. That's also not a good strategy either. You got to be a little bit more
You could like take those stocks that they're mentioning, look at them, and then make your own decision.
Absolutely. As long as there's a filter. And what I say to guys is build a filter. So if you've got a way in which you can assess a trade or an opportunity, so you can compare apples to apples. Like this is the thing. If I gave you two trades and I said, here's Apple, pardon the pun, here's Apple, here's Microsoft, and here's a trade in Apple, here's a trade on Microsoft, you decide which one you're going to do. People without a filter are going to go, oh, you know what? I've got an iMac and I've got an iPhone and I use Windows. So I don't know, I'll and they sort of like juggle them up and then make a choice. You've got to be able to look at it and say, okay, I'm going to compare them on the technical basis. I don't really look at fundamentals. Like I'm not a fundamental trader. I think at the end of the day, technicals drive most of the price action. Over the long term, I think fundamentals play a bigger role, but that means, a 5 to 10 year view.
Like investments, maybe.
Yeah. There's a big difference between investing and trading. Big difference. And I think in the short run with trading, I think technicals overrule everything. So you look at the technicals of Apple, you look at the technicals of McDonald's, and then you can make a choice as long as you're assessing them on an equal basis. So, we have ways in which you can, take the trades and even them off and make them, compare them, off the same platform. And it tells you, hey, this one scores a 20 and this one scores a 30. Okay, I'm going to go with the 30, So we've got that. That's one of the tools that we use, is trying to bring every trade down so that we can assess it on an equal footing. Most guys don't do that. It's hard work. When you start leveling trades and you start looking at them, comparing like to like, how would you compare a technology trade or a trade in, say, the semiconductor space to a trade in the utility space? Could you even do that? And that's what we try and do, is that there's sometimes that you're going to have these trades that are going to be from completely different sectors, completely different companies, but you can still equate them equally. And you can look at them and say, okay, you know what, apples to apples, this one is actually a better trade. And, that's one of our keys to success, is being able to look at trades from different sectors and then equal them off and then decide on who's the better one. But
what do you think about the utilities over the summer? They tend to perform
I like utilities. It's a tough sector to trade in because there's not a lot of volatility. So it becomes harder to, get these sort of, big little moves. When I say big little moves, I mean leveraged kind of moves, particularly in the options market. Longer term, I like them. You've just got to buy right. So you can't really be buying it up at the top range of its price. So you've got to understand its ranges of price. Don't be buying utility stocks up by the third Keltner. You got to get them towards the -1, -2 Keltner move. Those are safer bets on a lot of the sort of staple sort of trades.
Those also are good for. Do you think those are part of an inflationary strategy?
Yeah, there could be. I mean, if you're investing on that basis, it could be, because a lot of the utility companies have pass-throughs of cost, right? So if their costs rise, they just pass it straight through to the consumer. And that's the way in which the inflation trade works. It's that anyone who's got a high degree of raw material that's going to increase in price can often translate those into higher prices to the end user. So it's not a question of their costs are rising. They're just going to increase the price to the end user at the end anyway. So there are a couple agricultural ETFs worth looking at as well. Commodity ETFs, currencies. I'm pretty much in favor that the dollar will continue to lose value. I think that, high commodity-based economies like Australia, New Zealand, Canada are going to do better. So, if anyone wanted to sort of hedge their dollar positions, you want to go long Canada and long Australia. I still think gold's got room to move. I think last week we took some pretty chunky profits and kept our position on the table, but I still think there's a movement in gold up to over 1900. So I'm going to just quickly check and see where we are now on gold. So gold is trading on the GLD ETF at 178.67. So on the futures, in the futures, we're trading at 1910. So I still think there's room to move on gold and, to go up, but I wouldn't chase it. So if you're not in the trade, I wouldn't be chasing the trade. If you're in the trade, I would be sticking in the trade, until we start to stall out. We stalled out a little bit on Friday at around 177 on GLD, which we took some profits at that point. But I still think that, you know, a 180, 185 on GLD is, you know, probably likely over the next couple of weeks. I don't know when. I mean, the hardest thing in trading is time, right? I don't know when. No one knows when. You know, if it happens, great. If it doesn't happen, I'll just have to extend the trade and move it out. But I think gold's still got some room. I think that there's definitely opportunity. This is not, you know, you often hear the story about sell in May and go away, and everyone packs up their bags and goes and sits by a lake or the beach for the next 3 months. I don't think that's the case. I think what happens in summer is your opportunities just look different. There's certainly money to be made. It's just they look different. They're not the same kinds of trades that you would have had November to February when we were trading, you know, those high growth tech stocks and COVID, you know, stay at home kind of things. And now all of a sudden it's, you know, GE. I never thought that I'd be trading GE and GM and, you know, the sort of old stodgy companies, man. It can be quite a shock to the system when you see those companies elevated to the top of your list. I mean, you know, when you're so used to seeing things like Zoom and PayPal and, you know, modern technology kind of things. So summer is it's just a different approach. It's not a totally different way of trading. It's just you've got to be able to adjust your strategy from what you were doing towards the end of the year last year to now how we trade in summer. And it's the same every year.
I remember last year it was just really slow and there wasn't a lot of trading. So a lot more durational type trades, maybe.
You've got to you don't get the short-term directional moves that you would get normally in a high, you know, strongly trending market, but you do get these sort of, you know, 2 to 3 week trades. I mean, you've seen what we've been doing. We've been taking away that funnel of expiry. So we had a lot of positions that had the 17 June expiration, and we're now starting to move these out a little bit further. If the trade is still intact, we move them out into maybe August, September. Because what you don't want to be doing in summer is having a sort of compressional funnel. So you have like 40 trades all expiring on the same day. Like that's just nuts, right? So you sort of gradually peel them off, move them. If the trade is still valid, move them into a later expiry. And if it's not valid, just kill the trade. You know, exiting the trade. I mean, one of the things that we were looking to do is just get, you know, I don't think I know any trader that's good at killing bad trades. Like that's the hardest part of trading. Finding a good trade that doubles and all, that's not hard. That's really not hard. But finding, you know, getting into a trade after doing all of your work and then it goes down in price, it's like, crap, how do I get out of this? And then a lot of people rationalize. They do the yeah, but story. You know, the whole thing when you start talking to yourself about, I should get out of this trade because it's down, blah, 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 right? Factual point of price. And then you go, yeah, but it's above this, or yeah, but it's this, or yeah, but it's Monday, or whatever you want to say. As soon as you do the yeah, but, you got to kill the trade. You got to get out. That's the first sign of rationalizing a bad choice. And it comes from that sort of psychological need for a trader to always be right. And what you got to remember is, as traders, you're not here to be right. No one cares. They only care if you're profitable. You know, what you care about is making money, right? Not whether you were right. And it's such an interesting concept because you do all this work. You look at the charts. You try and find all these little edges, right? You get into the trade goes against you. And the first thing you want to say is, I've got to give it time. Yeah, but I'll give it time. And you give it an extra week. And now that minus 10% that you had last week is now minus 25%. And you go, yeah, but this. Minus 35%.
You're talking me through my mindset. All right. Like that's the hardest thing for me. It's like I'm trying to follow my rules about exiting, and it's
difficult. It's so hard. It's like when you're coaching one of your students and you're telling him, move your hips, or, you know, frame, or get up. You know, when a guy is getting the shoulder pressure in the face and from side control from some dude, and the coach is on the side going, get out. And you want to turn to him and say, what are you telling me to get out? I'm stuck underneath a guy that's like a monolith. You know, like, how am I going to get out? it's the same thing when it comes to trading. We sit and rationalize and justify, and yeah, I'll give it another day. Boom, minus another 10%, minus another 10%. Every time we do the year, but it costs us 10%. Just kill the damn trade. It doesn't mean you were wrong. It just means you might have been wrong in your timing at that point. So the thing is, like, a trade can be broken in terms of your tool, but the trade in terms of its structure might still be intact. So understanding that is the key to exiting poor trades. It's knowing when you have justified to yourself why you're staying in. As soon as you justify, out, just get out. Save yourself the heartache and misery of a poor performer. I would rather take a 20% loss than 100% loss. And last week was
I don't think there's anybody that would argue with
they would argue, right? No one would argue. I think last week was the first time in months where my weekly win-loss ratio was over 2. Like, I've been struggling to get it past the 2. That's my annual goal, is to get it above 2. And you can manipulate your win-loss ratio by improving the value of your wins or decreasing the value of your losses. Increasing the value of your wins is not under your control. You don't really control how much money you make on a trade. The market will give it to you. You have your price points, you exit, right? But in terms of deciding whether you want to lose 100% on a losing trade, or 25% on a losing trade, or 50% on a losing trade, that is totally under your control. So the way to adjust your loss, your win-loss ratio. Now, win-loss ratio is not the same as your win rate. It's not the same. It's the average win dollar value relative to the average loss dollar value. And what you want is always to be winning 2 times more than what you're losing. So for every $400 that I win, I want to be losing 100. That will keep my ratio intact, right? So when you've got that sort of mindset, as soon as something drops 25%, just kill it. Just get it. And particularly if you follow what we talk about often, the pilot strategy. If I just put a $200 trade on and I drop 25%, I'm out $50. Okay. I would rather kill that, take the $50 loss, go back into the trade later, double up at a better entry point, and make back $400 on that second trade, rather than see that first trade go minus 50, minus 100, minus 150. And then by the time it gets to minus $198, there's absolutely nothing you can do.
So if you when you plan those exits, you're talking about 25% of the stock price, 25% of the option price,
25% of the option price, and then I look at the stock price relative to its moving averages. So if the stock has dropped below its 8-day moving average, and my option price has degraded by 20%, if the price is underneath the 8 and I'm down 20%, I'm out, because the short-term momentum has moved away from my position, because the 8 has dropped, right? The price is below the 8, which means the 8-day moving average is going to start declining. I would then wait for the price to drop down. Maybe it gets to the 21. If it gets to the 21, I buy 2 contracts. So now I lost on the first one. Now I've got 2 contracts, and I bounce off the 21. I'm going to make back what I lost on that first trade. If it falls past the 21 and I'm down 20%, close the 2, wait for the 34. It hits the 34. If the structure is still intact, right, so it's still trending in the right way, gets to the 34, I buy 3. Now, if you take a stock like Google, all right, and you look at how Google operates around the 34-day moving average, anyone who trades Google knows that when it hits the 34 moving average, it's a buy, because it doesn't really get below the 34 average for long, number one, and number two, it doesn't happen very often. So when it does, it's shopping season. So buying 3 contracts at the 34, usually for the reversion to the mean, which would then be, sort of back to maybe the 8. So when the 34 goes back up to the 8, those are big money trades, big money trades. That's what you want to be doing. But it's a question of following that consistently across all your positions. You can't just have one rule for Google and then one rule for something else. 8, 21, 34, 1, 2, 3, 20% out, 2 contracts, 20%, and that's it. And that's the rule that I follow. And it works really well. I mean, it helped me a lot. Mathematically, it helps a lot as well, because when you're going in at the 8, you're never going to be putting your full allocation of your trade in there, because you're going at a high price. It's usually outside of your normal buy zone. At the 21, you go up with contracts, and then at 3, you go up with 3. It works for me, works for the clients.
Yeah,
that's how it helps.
So what do you think? How do you think this week is going to play out? I mean, historically, like, how is the post Memorial Day?
Let's have a look.
Short week.
Pull out the Trader's Bible. Hold on one second. Let's see. This is what you call being organized. It's somewhere here. Hold on a second. So we're now in June. So June, historically. Now, by the way, if you're not aware of it, this is the Stock Market Almanac. Really, really nice day. A really nice little book, and it tells you there's so much data in here. June is a horrible month. Don't have expectations to make tons. This is a matter of surviving, not thriving. Okay, so if you can make a bit of dosh on some of the trades, go ahead and do it. But this is primarily, if you look over here, it's a primarily red month, right? There's more. The down days are pretty much more than the up days. For the day after.
So you're looking at trend positions maybe before, like, going into.
I think the number of positions is not that important. I think what's important is where you put your money and how you trade it. So if you're going to be doing stuff, look for things that aren't going to be completely eliminated if you're wrong in the first instance, right? So go cheap. Use some butterflies. Don't just put long calls on things. Butterflies are probably going to be the cheaper way to play things, and make the net as wide as possible. Give yourself a lot of, a big margin for error. What we have here, the first trading day in June, Dow is up 26 of the last 33, and it's down 4 of the last 5 between 2008, 2012. It's a bullish day historically, and I can see that in the pre-market, it's pretty much like that. But I think what you've got to do is trade a plan, not trade the day. Like, if you try and trade the day, it's always going to be painful in summer, because you never really know what you're going to get. Last week or the week before last, we were operating almost like 2 days behind the seasonal thing. So I'd look at it and, oh, today's a bullish day, straight down the tube, and I'd be like, what the hell's going on?
Right.
Was it that pill that I took? Was it the painkillers? Like, really? Is Tylenol doing that to me now? So I think what you got to do is you've got to have a plan, and the plan should be, I'm going to trade 5 to 6 positions in those sectors that are going to be strong with relative strength. I'm going to do 1 to 2 positions on stocks. So single stocks versus ETFs, right? I'd have more in ETFs and I'd have less in stocks. That's the way I'm playing right now, is I have more in ETFs than in stocks. And I trade the strategy. It's like, okay, once I've got something like NVIDIA, for example, NVIDIA, we've got butterflies, we've got long calls, and we've got pull put spreads. So once I've decided how much my debit side of the trade is going to be through the calls and the call spreads, I'm going to start looking to finance them with some put spreads. So this way, what I do is I reduce my net capital usage on the trades. I have credits and debits offsetting each other. And I'm not looking for huge profits. I'm looking for 70% max gain on my put spreads and maybe, a double on my call spreads. That's it. And I let the market come to me. I set my exit prices when I get into the trade, and I let the trade come to me. I'm not going to sit here and fiddle around and do stuff. And I think that that's one of the disciplines of trading, is actually, once you put the trade in, get out of its way. Let it work for you. You've done the work. The only thing you've got to do is minus 25% down below the 8, out, kill it. It's like money is an employee. And if your employee is sitting in the back room, smoking pot, fire him. Like, just get rid of him. Like, there's no labor union here, and money will always go to the hands that treat it well. So if you think about it, if you've bought a position and it's down 25%, remember, some guy sold it to you.
Yeah.
So in options, you've got to always remember the guy on the other side of the table is taking money out of your pocket every time. So
yeah, it's definitely a zero-sum game. So, I mean, I don't care where the money comes from, honestly.
Nor do I. I mean, there's also this thing of you've got to be really sensitive to the level of skill on the other side of the trade. You know, if your counterpart has less experience than you, you'll probably win, because he'll be willing to sell you something at he's selling it to you at a low price, or he's buying it from you at a high price, something like that. But that's the way I look at the market, is I always try and feel like the person on the other side of the trade is smarter than me. And if they know more than me, what am I missing? Am I not seeing something? I always look at trades like that. What am I not seeing? And this is why indicators and algorithms and all of those things are really important, because they tend to get you into the sort of minutiae of the deal that might give you an edge. If I've got a 1% better clarity of vision on a trade than the other guy, that could be the difference between winning 100% and losing 100%. So, I'm a bit of an indicator junkie. I try and look for how we can get indicators to relate to each other. Like
you have some beautiful charts.
Well, my charts look like I landed up. Do you remember in the 80s, there was that craze that the kids had when they bought those things called the bedazzler, and they used to take their jeans,
like rhinestones and
stuff. Like, I was talking to someone the other day, and he's like, you know what? Your charts remind me of some kid in the 80s jeans with a lot of rhinestones, because I've just got colors. And look, every color says a story. Every indicator tells a story. The challenge is always the relationship between the indicators. And that's why I can't trade with one. I can't, because if you trade on a single indicator, and if you've been successful and you're doing that, fantastic. My brain just doesn't work like that, because I think I'm hardwired for the yeah, but kind of conversation. So it's like, I'm always looking for a reason not to do a trade. So if I see an opportunity, I'm looking for the reasons not to take it, not the reasons to take it. So when I analyze a trade, it's always like, what can go wrong? Like, what is the thing that can go wrong here? As opposed to, oh man, look at that, 97 green indicators. Let's go and do the trade. Because it's the 3 that weren't green that are going to kill you. And that's what you got to try and work out. And it's a learning curve. Not everyone gets it. And that's why some people's amateur trading careers are so short, because they tend to forget these rules. They don't appreciate the complexity that comes with this.
Which indicators do you think are the most, like, if you had to pick, let's say 3 to 5 indicators that you would suggest everybody use?
3 to 5 common ones, so ones that are easily available.
Right.
Not the proprietary ones. So I would probably say the first one would be just a simple exponential moving average layer. So you have the 8, the 13, the 21, the 34, the 50, 100, and 200. And what you're really looking for is, you have to understand that the shorter duration EMAs indicate more sort of short-term momentum, and the longer duration ones indicate trend. So as long as the price remains above the 8, the 13, the 21, a short duration trade of 21 to 30 days is probably in your favor. You got to watch those. I mean, it just means that it's positively stacked and it's setting up for movement in the right direction. So I would definitely use EMA stacks. The second one I would use would be Keltner channels, because stocks tend to gravitate towards the mean when they get overextended, right? In 2 directions, up and down. That's the second one. The third one I would use is called the squeeze. So it's basically the compression of the Bollinger Bands into the Keltner channels, which tells you that price is going to explode out either up or down. I definitely use that. I'd use the MACD, particularly to identify fast bullish crossovers. So where the fast line crosses over the slow line, particularly when it gets above 0. And when you have the MACD crossing up, going above 0, and a rising RSI, so relative strength indicator, that's a very bullish signal. So, not by themselves though. I would never trade on a high RSI by itself, because a stock can maintain its overbought status for a significant amount of time. A MACD can also change pretty quickly depending on your settings, but the normal 12, 26, 9, that I would keep it. Third one that I would use I would probably use an ADX. So the directional strength indicator, I would keep that above 25. That gives you a sort of an indication of the strength of the direction of the trend. So if it's above 25, you've got your positively stacked EMAs, your price is not above the first Keltner. Now you've got setups. Those are setups that you look for. Bullish crossover on the MACD. The squeeze indicator as well, if it's available, I would definitely use that. And that's just the compression, right? So that's the Bollingers inside the Keltner.
Most of these are available on like
pretty much TradingView, stock charts. Most of your trading platforms have got them as well. Yeah. I think that, some of the proprietary indicators, I have an indicator that looks at the trend of the squeeze, that how has the squeeze changed? What is the setup of the squeeze right now? What is the relationship with the ADX? What is the squeeze relationship with the momentum indicators like the DMI? All of those things are in my indicator that I've built, which is called an Alpha Hunter indicator. And I know that any trade that I do where that indicator says it's above 70 generally works out. I've got a sort of 80 to 90% chance of that trade working out to the bullish side if that indicator if it's there.
But you've combined a lot of different indicators and
there's about 40.
Save yourself a whole lot of time.
Oh yeah, there's about 40 in that indicator. It's a very complex algorithm. It's not an easy thing to replicate. However, it does save you time because sometimes a trade can be very quick. I don't have the time to sit and manually look at 40 different charts. I just look at that. Did it score over 50 or over 70? Yes. Okay, I'll do the trade. Like that. That's the way I work because I know what's gone into the indicator behind it. Right. And that's how you do it. It's not. You've got to find what works for you. There's some purists that look at my charts and go, way too much noise, like too many things. I go, okay. Everyone's got their own style and way of trading. I trial and error has led me to the point where I have to look at, maybe I've got about 8 or 9 indicators that I will use in conjunction with my 40 algorithm one. And it just gives me that certainty. When you trade, you've got to trade with a degree of confidence. You can't just trade because someone told you so. That's not healthy at all.
Right.
You create a dependency that way. I'm a big believer in teaching someone how to create their own system of trading rather than copying someone else, because that copying of someone else might not work for you. Like no one knows if it's going to work. And then you spend years and years and years trying to do that, lots of losses, when the answer was just simply do this, this, and this. And that worked for you. Okay, keep doing it.
It's kind of like, I think a lot of skills are like that, where it's like you imitate and then you adapt it to your own style.
Yeah, jiu-jitsu is like that for me. I can't do some of these technical things that others do. My leg lock game is atrocious. Like it just doesn't exist because I started learning it too late in my career. So for me to learn it now, no. Does it work? Of course it works, but it works for certain people who've been doing it for years. My game is like a sloth combined with a dead whale. Like that's my game, right? I'm not the most exciting competitor to watch, except for my animal noises that I'll make when someone puts me in a lock. No referee. I didn't verbally tap. I was making the mating call of a Madagascan sloth. Like, come on.
Your power. You were channeling your inner sloth.
Channeling my inner sloth. It's like, is it ref? The guy's unconscious. No. I'm just taking a nap. I'm just sleeping. Just give me a break. I can't process everything. But that's how you've got to trade. You've got to find what works for you, what generates your wins. Like, unless you're tracking your personal success rate on the processes and setups that you are following, everything you are doing is wrong. Like, that's the way I look at it. Everything you're doing is wrong because you have no idea of knowing what's contributing to your success. This is just luck. There's nothing fundamental behind it. So if someone said to you, why are you lucky? Or why are you winning? You could never explain it.
Right.
That's the thing. You have to be able to do that. If you can't explain why you're winning, you're not really winning.
That's true. I mean, your luck's gonna run out at some point.
And you know what happens? It's when people double up, lose. So the first 5 wins were like, I can't do anything wrong. I'm brilliant. I've just tapped out 9 brown belts, and then you land up getting some monster you know, and I'm going to try the same thing. I Kimura at everyone else. And then you try the Kimura and he breaks your neck or something.
Yeah.
It's like,
I've had that happen in jiu-jitsu and in trading. So I'm good now. So yeah, I'm watching myself. All right, Chris. Well, the bells. Oh, go ahead.
You've got to check yourself. It's like, it's always, you know, as a trader, you've got to remember that you're not always the best. You know, so
right.
It's a hard thing, hard process.
All right.
There you go, my friend.
We'll talk to you next week, and good. Hope you have a profitable week.
I hope so too, man. I'll see you next week, buddy.
All right. Take
Take
care.
it easy, man.